Okay. Okay, very good then. Good morning, everyone. Good afternoon, good evening. And I'm Giuseppe Basile. Today I will be your host. Thanks a lot for joining in. Today I'm going to talk about writing a trading system that works and why this is very, 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 very important. My work on trading systems is connected to my work on the tasks of the mental models to become a consistent trader. And if you go on my page on FX Street, you'll find a lot of work and a new series also on reaching profitability and consistency. Everything is connected, and today I'm going to give another piece of the puzzle and why it's very, very important that you formalize your method. I find a lot of traders and starting traders who actually have use a lot of discretion in their trading, and that's not okay. Some of them initially experience success, but then what happens is that that does not continue in the long term, and that's what we want on the other hand. Okay, so I want to thank Adinda and Vicky for organizing this webinar. Thanks a lot. So I'm going to get into it. So this is the agenda, an introduction. I'll do also a brief announcement on the Toronto Money Show. And if you are in the Toronto area, join us on Saturday, October the 31st. It's going to be a special session of the FX Sessions Toronto. I'll then review the current market very briefly and the activity of the plunge protection team, and then we get into the content. As usual, my webinars are very packed, so there's a lot of content to go through. I'll talk about why a trading system is needed, and then start talking about parts of a trading system. This is also a series. It's going to be a series of 2-3 webinars, and it's going to be introductory to another series I'm going to run in November and December, whereas I'll present an actual trading system, and then we're going to formalize it together. So stay tuned. Come to these webinars, because I believe you're going to get not only the trading system, but also the way that's derived, and most importantly, the way you have to test it to develop confidence. Now, if you know me, you know also that I believe that traders' job number one is risk management. All my trading revolves around obtaining a free trade as soon as possible. And that's it, because we don't know what can happen in the market. Anything can happen in the market. So my trading is very, very specific and oriented to have a very, very specific initial objective, and then let the market develop. I'm not going to talk about myself. If you watch some of my webinars, you can find my bio there. I will only say that I've done in the last few years researches for SIAT, which is the local Italian chapter of the International Federation of Tech Analysts. And recently I have associated myself to the Canadian Society of Tech Analysts, and 2 weeks ago I went to present at the annual conference of the CSTA. I've also presented in another conference in Italy, and the Money Show as well twice. This is going to be the second time. So I'll save you on this. Fib stalk. I do not stalk people. I stalk price using Fibonacci, and that's the reason for this nice nickname here. And we will see an example today as well. So, as the plunge protection team done it again? Yes, they did. They did, and we had this 1874 level on the charts well before the fact. And imagine what happened is that level was retested, and this was a couple of weeks ago here. As you can see here, that level was retested almost to the pip. So there is there is a lot of energy being expended here in this market, and it's very difficult that this market now is going to, but this market is moving higher, but it's very difficult it's going to break this level now. If that happens, it's a major change in the SP 500. Okay, we're talking about the SP 500 here. So how do we, how do I model this price? I model this price the same way we modeled the lows in 1987, believe it or not, as well as the break that happened in 2002, which actually then created the full 50% retracement in 2003, which was retested in 2009. Okay, so we had the double test here. The way it works is that once you have that level already in place, you study the sequence of measure move as the market gets into the level, and if that counter trend sequence of measure move fails, then that's an indication then the participation coming at these levels is much stronger than the participation that actually creates a structure on price as the market moves in that counter trend move lower into the level. Now, if we look at what happened recently, there was the same thing here. We had this move lower, and the market actually has done the same. So what I mean here is that we had this level here, which was already identified, and there was a second test. And second tests are dangerous tests. Second test, it's where the magic happen if it happens. Why? Because when the market reacts at this level, it means that there are longs, of course. And when the market comes back to the same levels, although longs started entering here from lower levels, very, very quickly though, when the market comes back to this level, there are some people who will actually unwind their position. So in order for the market to bounce again, we need a lot of participation. Why? Because we need two group of people. There are two groups of people involved. One are the people who entered here and now they're exiting the market here. Plus, we need additional participation again to push this price higher. So whenever you see a double test, like in this case, and this is not a double bottom for me, this is a test of this 50% level, okay, which was identified before the fact, and I'm going to show you how that was identified. But what I want to say here is that whenever you see a second test, you have always to remember that there is a group of people who's leaving the market. The people who entered here at different level, there are some of them that are leaving the market when they see the market retracing into this level. And then there is another group of people who's coming in again and pushing this price higher. So that's why when you see double bottoms or double tops, they're quite powerful because they also show this additional participation that has to offset the people that exit the market here. And that's the reason why it is also said that double tests, the second test is the dangerous test. So we had the first test. The second test is the dangerous test for this reason, because of this need to offset also the volume of people who actually leave the market. And then there is what we have here. Then any other test that might happen later on, it's less dangerous than the second test because of the commitment that is already there. Okay. Some people told S&P could test 1714 levels, the S&P 1740 levels. Well, I always look at thanks for the questions. I always look at these levels, and until the lower level here is pierced, which to me indicates the end of participation here, and this lower levels was just above 1800. So people who had 1740 at this level here, more or less, this area here, and for me this area had no meaning. The meaning is either the market participated at these levels, within this area indeed, or if it pierces the 61.8% level, I am not looking at participation in this area anymore. And believe it or not, this can be one tick in the SP 500. It can be one pip in the. Okay, can you hear me? Give me a yes if you can hear me. I hear that someone has problems on the audio. Vishwanath has problems on the audio. Okay, so probably Vishwanath, you have to check on your side. Okay, so just to answer then the question from the question I saw before there from MRC, 1740 had no place in my current view. Now, if the market broke this level here and the outlook for this market would have changed completely, because it means that the sequence of measure move that we are seeing on the weekly time frame has ended, and that means that the bulls are not interested in keep pushing this price higher any longer, which means that the bull might be in control. Okay, so this level had no meaning for me, to answer your question. So let's continue here. So now I just want to show very quickly that whenever we had this value, whenever we have these levels on the charts, these are not levels that you want to buy blindly, okay? And the way it works is that you need to get a confirmation. And if you know a little bit my work, you now know that I study algorithms and I study the way they actually influence all the time frames, and that can only be done on high volume market. It cannot be done on all the markets because algorithms to be in a market need volume as well. So what I do, I have an area that is identified by a 50%, 61% level, and that's where I anticipate participation from the larger time frame. Now, we don't know if that participation will come because we don't know what is going to happen in the market. And if you assume anything about the market, even peak risk sizes and a behavior of price, you set yourself for failure. So what you have to do here, and what I normally do, I study the sequence of measure move on the opposite direction. So the counter trend move into that level, and when that measure move fails, then that's when the time that I get involved long or confirm a direction. So very quickly here, I want to study on the 4-hour time frame the sequence down here, which we can see in these 3 daily bars here, sorry, in these 3 weekly bars here, and I wanna show you how, from a practical point of view, you do that. And this is the schematic here. So you have the 50% level before, and then what you do, you actually study the sequence of measure move as the market gets into that level. And this is not complicated to do. Indeed, I have a procedural way of doing that, and that's the beauty of it, because it removes a lot of emotions and discipline problem from the timing process and from the trading process as well. So now I used that and I showed that in the past. If you go back July 2015 call, and then I also showed that in September. So the way it works is that if there is participation, this sequence breaks, the short sequence breaks, and there's a very the well-defined level where that happen. If the market gets above the level, in this case for longs, and the same happens for shorts, then it's a confirmation that the algorithms that are coming in this area are stronger than the algorithms that are pushing price lower. Okay, so that's the way it works. And again, you can review September 14th when I that level was already there from July. So let's apply the Phillips Tolkien time into this time frame. So we are starting here, it's the counter trend move from this high to lows here, and I'm going to show that on the 4-hour time frame. On the 4-hour time frame, you can recognize that structure. Okay, the structure is not random; it's actually imposed by algorithms, and see, you can make how many mistakes you want in trying to recognize that sequence in the higher part of the correction, because this 50% level has not been tested yet. So this method is very forgiving, meaning that if you don't capture the sequence at the beginning, you have a lot of time to capture that sequence. And even after price has tested this level, you have still a lot of time. In this case, these are 4-hour bars, so we're talking about days here before the market gives a confirmation on this time frame. So let's suppose that you had not identified the sequence of measurable. Let's suppose that initially you traced from this level to this level, and you saw that the 50% did not really model this area here. So you wait and see how the market develops. Now, this is also a spike, so sometimes the algorithms do not attach themselves to the high, but they attach themselves to the high before the spike. So when you were using that, let's suppose that you don't see, the market is still not, the market is still, let's say, the market is here, so you don't see all the right side, the hard edge, you don't see it, but then you see that the market starts participating at a level here. So you find the anchor, and the anchor in this case is this one. When you trace from this level to this level, that's exactly where participation is. Once that participation is confirmed and the market continues lower, that's what you use. So the next measure move is going to be from this level to lows, and it gives you another area of participation here. The market tries to participate on the downside to continue, but then eventually it breaks this level, and that's your confirmation that the bulls actually broke the back of the bears, if you want to use such an aggressive expression, but that's what actually happens here. Okay, and that's a confirmation that the market is actually continuing higher. So, excuse me. Excuse me. As you can see here, that's exactly the application of this process. So you have the 50% below E, which is this 50% level here. So E will be here. And then you have the sequence of measured move. Now, in this case of the example of the schematic, there are 1, 2, 3, and the fourth one fails, right? And in this example, you only have 2. You have this one, and then the next one fails. But that's one measured move. It's enough to study the sequence of measurement. So I hope this gives you an appreciation or an idea of how it works. Now, before we get into the next one, I just want to make a brief announcement here. This Saturday, October the 31st, I will be talking at the World Money Show. We will be gladly representing FS Street, and this is going to be a special session of the FS Street Sessions Toronto. We're going to talk more about the use of Fibonacci traces to model algorithms in the market. Even if you are not in the GTA area, if you don't live in Toronto, please register, because we're going to send you the recording of the presentation. That's a picture of last year at the same conference. A brief announcement here. So let's go back now to the content. If you have any questions about what I just showed to you, feel free to add. and in the chat. And I want to get into the content. I wrote the 7 pillars of modern markets, and this is really a way to structure all the knowledge you have to get and you have to keep building in order to be successful in the market. So when we talk about the trading system, we talk about really a way of modeling the mechanics of the market. So basically we are talking about this area here, okay, and also including trading as a business, which is this central gray that we have, component that we have here. So you will remember that in the last few series I've focused on psychology of the market, so you can review some of those webinars. Now we are going to talk about this badminton ball here, which is the trading as a business plus all the mechanics of trading. Why is this important? Because, see, these are the tools that we use to create confidence on our trading method, and there's only one way to create confidence: to test, and more test. And imagine what the disadvantage have traders who do not even have a formalized trading system, and I meet a lot of them very often. So now, trading system development, it's a science and an art. It's a well-developed discipline. If you don't know anything about it, I find it very fascinating. Well, I have a background in computer science engineering as well, so I like to work with models and see and build systems as well. Now, there are some notable names in this area. You will probably recognize Robert Pardo here, who wrote a few beautiful books. Van Tarp, it's one of the mentors ahead, but also Perry Kaufman, George Pruitt, Jeffrey Katz are great, are big names, and they really contributed to the trading system development. If you review the books of these guys here, this is really golden. If you manage to understand how to write and formalize your trading system in a trading system, a formalized version, you'll have the rules that you can test very, very closely, and you know exactly what you have. We'll talk about this a little bit later today. Building a trading system requires a few components. It requires a setup, so you need data, a charting software, very backtesting. Now, I'm talking about here generally how you tackle this, okay? If you have to start from scratch and you have to create a trading system, that's what you need. Of course, none of us want to do that. We want to try to reuse as much as possible and leverage on the shoulder of the giants, as I say, which is exactly what I did to create my own trading systems. Of course, I mean, I looked at the work of other brilliant people, and I tried to add a little bit to it and improve to it, but most importantly, to formalize it in a way that I can use it. We have to devise and design the concepts behind your system. If you don't want to do that, leverage someone else's systems. And of course, you want to test it and make sure that it works for you. Decision making, which is partly subsystem and partly design decisions, and practice. You have to derive the numbers that characterize your trading system. Now, this is very, very important. This is one of the main reasons I want to have a formalized trading system, because that's the only way I can understand mathematically, numerically, what my system is capable of. And there's no other way to do that. You have to formalize the trading system, and then you have to apply the trading system to data, which is your past data, or you can pivot trade as well, so you can see how that system behaves with current price data. And but that's very, very important, because once you have some key measures that I'm going to give later today or in the next webinar of this series, you will see that you have so much power with you. You have so much understanding of what you can do with the system. And actually, you can bring also your trading to the next level by applying money management to specific money management, design specific money management for your trading system. Guys, this is powerful stuff. This is a lot of people never understand, and that's the reason why they cannot produce consistent results. So this is very, very important, and I'm going to give you more information as we go. You have to repeat, perfect the data execution, and make sure that you're consistently getting the results. Now, one important thing and characteristic of a trading system is that it gives you exact instructions on what you have to do. So if you tested that system and it works and it has an edge and you developed confidence, it doesn't end there, because you have to execute as well to kind of replicate exactly the same results. Okay, and this can be more difficult, simpler, depending on, it always goes down to one aspect for me: how much discretion you have in your system. If you don't have discretion or very limited discretion in the system, then things are much easier. Let's go back to what I told here. You know, I showed an example here of this, and then I said, you know, that's the way we look at it. If you have discretion in identifying these levels here, of course, you're putting more complexity in your execution and in your system. But if this is procedural, for example, things change completely. And you want to have, for example, a timing mechanism that is procedural, but also have identify the level where you want to get involved when the set and where the setup has to be triggered in as much as possible in a procedural way. Okay, so let's continue here. So once you have done this kind of testing, and that's the reason why you also want a trading system, you go live, and then after that you can do a lot of stuff as well. So you can actually do you can perfect your trading system, add money manager specific to the edge that the trading system models, and I'm going to show you how you can model that. Look at the most important components as well of your trading system. I'll show you 10 parts of a trading system, and each of them is very, very important. You have to fully understand the what each part does. Now you can make the heavy lifting and design your trading system. I generally suggest you learn how to design one, because then you get an understanding of trading and the mechanics of price that you will not get if you don't do that. But if you don't want to do that, you can adapt other methods. Fixed Talker is one of them, but there are others, of course. Still, some decision will be necessary, and you will need to make some adjustment also based on the time that you have available. For example, do you trade a daily, the 4 hour, or can you trade on the 15 minutes? Can you time on the 1 minute? But also risk aversion and preferences. Okay. So these are the components that are required by a trading system. Now, I've presented this, so I'm not gonna go into detail. If you are interested in learning the model of profitability and consistency, I have a webinar series on FS Street. By no means go and review. This is very, very important. And one of the things I say there, that profitability is about solving problems on distinctions on price, while consistency is solving problem on your beliefs. Now, I just want to show this to show you where trading system is in all this sequence of things that you will need to master if you want to become consistent in a very procedural way. So trading systems are here, okay? So they are on top of the mechanics of trading. And I always say the mechanic of trading, the trading method, the timing, the money management, risk management are all skills that can be learned. There's nothing magic about this, okay? And so a lot of people believe that that's what they need or what they want, and that's the only thing they need. And so they come to me and say, "Give me the trading system." Of course, I mean that's not a problem. The problem is, how do you formalize all your knowledge and create a trading system, and then you keep using the trading system to create confidence, to tune it, and then to kind of propel yourself towards reaching consistency that requires a totally different type of problems to be solved. Okay, so that's just to show where we are, and there are three areas here: mechanicals trading, trading system, and tuning and confidence building, and then there is the game the game of improving your beliefs, improving your this, which is totally different. So these are more or less also the three areas that I touch in the Phipps Talker Methods Coaching Program. Now, let's get into the details here. There are several parts of the trading system that you have to understand, and you have to learn to design them. And if you stay with me in this series, I'm going to show you how to design the trading system so that you have it formalized and you have no excuses to introduce discretion in your trading. Now, if you like discretion in your trading, feel free. But if you believe that with discretion you will be able to reach consistency, I believe that's a little bit difficult, actually very difficult. That's the reason why 95% of retail traders lose money in the market. They never formalize, never treat this as a business and formalize the trading system. So there are a number of parts here: market selection, direction, setup and filters, entry or market timing if you wish, stops. There are different types of protected stops. I don't know if you know all of them, but and not all of them are necessary, but it's important that you know them. Re-entry, very, very specific part of a system: profit taking, position sizing and position management. And then there are two other characteristics here of trading system: how they participate in a portfolio. You may have a portfolio of trading system or the same trading system being applied to multiple positions in your portfolio. So you need to understand what's the percentage of risk, position size that you assign to each of it. And then, do you have multiple systems? Do we need multiple systems? The answer is an obvious yes. And the reason for that is that the market can do anything. This is my number one belief. I have three beliefs. The first one is the market can do anything. Three main beliefs, of course, about the market. I have a lot of beliefs about the market. The market can do anything. Okay, number one. Number two, trading is a business where we are paid for the quality of the decision that we do. And as a corollary of this number one, I also have another one, which is jobs. Trader's job number one is risk management, and then the other one is PPC, protect precious capital. Okay, you have to keep these things in mind. I have many more beliefs about trading. I've worked with my beliefs about trading because consistency depends on beliefs. When you have to manage issues like discipline, over trading, revenge trading, and you name it, there are tens and tens of this behavior. The only way to work with them is through a trading system and then working on your beliefs. So let's get into this and let's look very quickly here at some of this. Let's start doing this work here of understanding the parts of a trading system. This is very important, and you need to know this. Now, market selection, as you can see from the name, I mean, it's very intuitive. Generally, you should ask, okay, why want to trade those specific markets? Okay, this is again, this is if you are creating a trading system from scratch. Now, if you're not doing that, or someone else is doing it for you, someone else is doing the heavy lifting for you. But it's very important to still understand these aspects. If you don't understand these aspects, you you won't have the tools to create profitability and consistency. At least that's my opinion. So why do you want to trade certain markets rather than another? Why you want to trade Forex versus stocks or futures or commodities and of course you apply the selection of the market that you want to trade to your trading edge, or it should be the opposite. Your trading edge or trading method also specifies a way to select the market. And typically, you start from a group of a bunch of markets. For example, you can say, I will trade all the major Forex pairs, and then you apply some mechanism that are specified within your trading system to select some of those markets for opportunities. Some trading system designer like to look at the big picture as well. There are different ways of getting a big picture on the market. It can be based on fundamentals. It can be based on how the major players are positioned on the market, and it can be also. And these are the two main ones actually. One is fundamental and one is technical. Of course, when it comes to technicals, you can model the market in different ways. For example, I like to model the positioning of algorithms in all time frames, starting from monthly, weekly, daily, and of course, when you have that, that's what I do in my method. I call that price analysis and discovery. When you have that, you have a number of these 50% level, long and short, and kind of your trade, if this is a 50%, let's say this is a 50% short and this is a 50% long, and let's say this is a weekly and this is a daily, your trade has to develop within this area. Okay. Now, some people identify these levels using fundamentals, and they say, we believe that the dollar index will go to 104, or we believe the euro dollar will go to parity, and things like that. I don't believe in that kind of approach because it's too loosened. It doesn't give myself level and confidence that I need. So obviously my approach is technical, and I look at algorithms, how they are placed in different time frames. And then you identify the path of least resistance. So your trade has to kind of develop somewhere within this area, because you don't want to risk that if you are, let's say that you are long here, right? You don't want to risk that price gets there and then there is participation from short, and so you lose the opportunity. So you need to know these kind of things. The big picture, technical or fundamental, you have to know it depending on what you trade. And some people subscribe to service offering information. That is okay. The problem is that every time you put more information, you add information, there are problems there. Why? Because you need to reconcile that information. People believe that they can use 5 indicators on their chart and use it as confirmation. The more information you get, the more you need to reconcile. And people never understand this, that reconciliation and more information require more reconciliation, which requires basically more work to do if you're serious about trading, because trading is a business and you have to know exactly each of the possible configuration of these indicators and then combine all of them together, which gives you an exponential amount of work. So I like to keep it simple on the other hand, because that also means manageable. So which strategy and trading concept you want to apply? There are band trading, trend follow, if stalk, whatever you want, but you need to have that. Now, if you don't want to create all this, you can do price structure analysis that auto preselects the markets. And again, there are different ways to do that price structure analysis. And you need a valid trading edge, and you can get the big picture always from other services, but be careful because that can be counterproductive. Okay, so market selection is about what are the markets that I want to I want to trade and why. So what are the markets I want to apply my trading edge? Market direction is obvious as well, and this is about what the market price is doing, it's more likely to do. And are we in a raging bear, in a correction? Are we in a bull move? If we look at the SP 500 at the moment, where are we? We are in a continuation, an extension long bull move. And actually, let me tell this. I have some colleagues who believe that we are in the last phase of the 40-year cycle. And the cycles, they already have they always have the same structure. Okay, so this 40-year cycle, the last one, started in 1987 at the lows of the 1987, and people who study cycles, these long-term cycles, 40-year cycles, they always say that the cycles have this structure: a first low, a second low, and then there is the last leg higher. Now, according to this view, the next low of the cycle should come on 2026, believe it or not. Now, it does not mean that this market will continue higher till 2026. It means that around this date we will have the next low. So at some point, this market will actually move lower for a multi-year move. That's what a lot of people believe. And so we are in the last part of this move. I found this very fascinating, actually, and every low never goes below the previous one, every low of the 40-year cycle. So now I'm not a cycle expert. I just found this very fascinating and something that can be useful to you as well. So which are the current market conditions? Is size, volatile, or quiet? If you look at the SP 500, it's definitely, I would say quiet still, although it's becoming more volatile at the moment. We exited an area of sideways movement, and we are moving higher. So again, for market direction, what do you need if you don't want to do the heavy lifting? You need a mean to define price structure analysis and price discovery. You need to know where the market is going, and to do that, you need to know the path of least resistance. Again, I mean, I give reference to my model. I mean, if we have a 50% long on the weekly, and the market has participated to that level. Again, can you see? I'm not implying anything about the market. The market can do this, but the market can also do this. So that's why we always need a mechanism to test the market here when it approaches these levels. Now, if a weekly level has participated and there is a daily or a weekly short somewhere there, I need to know that. You need to do price structure analysis. You need to do some sort of price discovery. Now, when I say price discovery here, this is related to price analysis, not the price discovery that market does to actually see price does to see whether there is demand at certain level or supply at certain level. That's also called price discovery. I kind of redefine it in my own context, which means for me to understand, based on the information I've collected so far, to make a projection of where the price could actually go. I call that price discovery. But I don't like definitions because I don't hide behind definition. That's something that helps me anyway. Consideration on price structure offer information on the direction as an edge, because we need to know how, in my case, how algos are positioned so that we can trade without going against large area of potential participation in the direction opposite of the trade that we want to take or we are on. Consideration, knowing current market condition generally does not help. So when I say market condition, I'm making reference here to fundamentals. I mean, of course, knowing fundamentals can be useful, but we cannot, when I say it does not help, it means we cannot leverage only fundamentals. Fundamentals can be good to know that maybe a move that has started or is going on. For example, think of the euro, that is a move that could continue. Although I'm going to show you something about the euro. And so market conditions or fundamentals enough are not enough. So you need to follow rules for identifying path of least resistance. For example, that's just an example. There are a number of rules, and direction is clearly given after some sort of analysis that tells you how the players are positioned in the market. So we still have, I believe, a few minutes here. So I wanted to touch very briefly on the different type of markets, and then maybe we'll see whether we have still additional time. So the ability of any system so the trading system has to be able to respond to different type of market, okay? So there are different type of markets, and you have to know how your trading system, your method, your discretionary method, I hope not, actually behaves when you have these different types of markets. So, and some select markets and direction based on the current type of the market. So now it is really important to model the type of markets. It really depends on what are the degree of freedom of your system. We will talk about the degree of freedom later on in this series. That's very, very important. You need to understand that the more you test and optimize your system, the more you fit your system to data, the current data that you have. And that's why, in modern trading system development and testing, they talk about testing, out of sample testing, which means to test the system outside the data range that you use for testing. So I see here that we have to wrap up. So I'm going to give you an idea very quickly of the different type of markets. Whenever you have to analyze a market, you always have to know whether the market is volatile or quiet market and is going up, sideways, and down. And you want to try to have a system and models that actually are capable of adapting or generating trading system that actually can capture different type of markets. So I would actually close it here for today. What I want to remind besides this is that on my page you're going to find a few series where I speak about, where I talk about the psychology of the market, the psychology, the journey to profitability and trading consistency, as well as I introduced it in the past, the 7 pillars of modern markets. So if you're interested in what you don't have to do in the market, I also recommend how to get and stay into the elite in 4 parts. And if you want to have fun and understand money management, don't lose how to challenge yourself for greater returns in modern markets. So we will continue our series varying trading system, and I will give you a trading system as well as part of this series. So I hope you enjoyed it today. I know this might not be the type of webinar you're used to. A lot of people, they want to see price, and I have nothing against reviewing current markets. The point is that I want to try to give something more and something that you can use in order to develop proficiency profitability and consistency, but also, and most importantly, treating this as a business, which means that you have to know what's your risk, what's your system, you have to know your numbers, and you have to know the structure of the process that you have to follow in order to make this happen in a, I would say, almost procedural way. If you do these things, you'll be able to reap the benefits. So thanks a lot for participating, and I hope you enjoyed the content.